Today, we're analyzing China Northern Rare Earth, a global leader that finds itself right at the intersection of powerful market fundamentals and shifting geopolitical strategy. Our analysis shows a market currently fixated on short-term geopolitical risk, which has created a fascinating divergence from the company's long-term strategic position.
And this is the number I want you to focus on, negative 9.26%. That's the stock's underperformance against the CSI 300 index since September 1st, 2025. Now, what makes this so striking is that this drop happened right when we were getting what seemed like very positive news for the entire rare earth industry.
So, that brings us to the core puzzle of this analysis. Why would a major strategic policy, one that was explicitly designed to strengthen the company's hand, actually trigger such a sharp, negative reaction from the market? Let's unpack the factors behind this.
To really get to the bottom of this contradiction, we first need to look at the immediate market data. The reaction itself tells us a lot about how global capital is thinking and moving right now. You see, the sell-off wasn't triggered by any sort of weakness in the company's core business. Not at all. It was a direct result of global investors hitting the pause button and completely reassessing geopolitical risk after China announced new export controls on rare earth technology. So now let's examine exactly how these geopolitical factors started to influence asset prices on a global scale. And this is where the divergence in performance becomes incredibly clear. This table really lays it all out. Look at this stark contrast. While Northern Rare Earth fell over 7%, its main Western competitors, MP Materials and Lynas, saw massive gains. We're talking double digits. It's a textbook example of capital rotating out of the Chinese market leader and flowing directly into its global peers. And this slide really sums up the market's narrative. Investors started pricing in what you could call a geopolitical safety premium. All of a sudden, non-Chinese producers were seen as safer bets, as beneficiaries of this global push to diversify critical supply chains away from any perceived policy risks. Okay, so that's the short-term market sentiment. But now, let's peel back that layer and analyze the company's underlying operational and financial structure, which, well, it tells a very different story. Northern Rare Earth's dominant position is really built on some incredible foundational strengths. We're talking about a vertically integrated industry leader. It has exclusive access to the Bayan Obo mine, the world's single largest source of light rare earths. This guarantees a stable, long-term supply of raw materials and allows it to focus on high-value products like permanent magnets, which, as you know, are absolutely critical for things like EVs and wind turbines.
Now, to really understand their financials, you have to grasp this concept of profit transmission lag. It's a unique pricing mechanism that creates some pretty significant swings in profit. Here's how it works. When rare earth prices are rising, the company sells its products at the current high price, but its cost for raw materials is based on the previous quarter's lower prices. That expands margins dramatically. Of course, the exact opposite happens in a downturn. This is really the key to understanding their performance. And this DuPont analysis shows you that mechanism in action. Just look at the drop in return on equity, from nearly 33% in 2022 all the way down. You can see it was driven almost entirely by the collapse in the sales net margin. But, and this is the important part, look at the data for the first half of 2025. That margin has started to recover, climbing from about 3% to nearly 5%. That's a clear signal of a potential turnaround in profitability as market prices have started to improve. All right, let's get back to the policy that kicked off this whole market reaction and really analyze its deeper strategic implications. This was the pivotal moment, and the absolutely crucial detail here is that the controls target the technology, the intellectual property for extraction and separation, not just the raw materials themselves. This represents a fundamental shift in strategy. And you can really see that shift illustrated here. For years, the strategy was all about controlling the physical supply through production quotas. The new strategy is about creating a technological barrier to entry, making it much, much harder for potential competitors to ever develop their own advanced processing capabilities. So what's the long-term objective here? It's a clear move away from simply controlling supply to establishing a more defensible, technology-based dominance in the market. The ultimate goal is to solidify pricing power for the long haul. And this chart shows you exactly why controlling that technology is so critical. Right now, China refines roughly 90% of the world's rare earths.
By controlling the export of the know-how needed for this incredibly complex process, the strategy aims to maintain that commanding lead in the most profitable part of the entire supply chain. Of course, a thorough analysis means we have to look at the potential challenges. So let's examine the counterarguments and the downside risks to this long-term strategic outlook. There are several key risks to keep on the radar. First, geopolitical countermeasures are a major one. This policy could actually accelerate efforts in the West to build out alternative supply chains. There's also domestic policy risk. And of course, a global recession would certainly hit demand from key industries. Finally, we know that competitors like MP Materials are working hard to expand non-Chinese supply. So, to bring it all together, our analysis identifies a major disconnect between the market's short-term, geopolitically driven view and a fundamentals-based assessment of the company's strengthening competitive position and its long-term earnings potential. And this leaves us with a final, critical question. In an era where global supply chains are actively being redrawn along geopolitical lines, what will ultimately be the true driver of value? Will it be short-term market sentiment, or will it be long-term corporate fundamentals? That is the central tension to watch going forward.